What if I told you that silver could reach $400 per ounce by March 2026? Not in 10 years, not someday, in March. Most people will say that's impossible. They'll call it hype, they'll laugh it off. But here's what they don't understand. Something extraordinary is building in the silver market right now. A perfect storm that has never happened before in modern commodity trading. We're talking about 180,000 contracts standing for delivery at the same time. To put this in perspective, that's 900 million ounces of silver. 900 million ounces that shorts might need to deliver in physical form. But here's the problem. That much silver doesn't exist. Not in deliverable form, not in COMEX warehouses, not anywhere close. This isn't about supply and demand in the traditional sense. This is about a structural break in the market itself, the kind of event that happens once in a generation, maybe once in a lifetime. Today, we're going to walk through exactly why silver could hit $400. We'll look at the specific dates that matter, the mechanics of what's happening, and why the shorts have no good way out. By the end of this video, you'll understand why March 2026 could be the month that changes the silver market forever. This isn't financial advice. This is market analysis. The numbers don't lie. Before we dive into the March madness, you need to understand how the COMEX silver market actually works. COMEX is the commodity exchange in New York. It's where most silver futures trading happens globally. When traders buy or sell silver futures, they're not usually dealing with physical metal. They're trading contracts, paper promises. Most of these contracts never result in physical delivery, but something is different this time. We're seeing an unprecedented number of contracts where longs are demanding physical delivery, not cash, not rollover, actual silver bars. Here's where it gets interesting. COMEX has about 50 to 70 million ounces of registered silver available for delivery. Registered means it's been approved and is sitting in COMEX warehouses ready to be delivered. Now do the math. 180,000 contracts equals 900 million ounces. Available registered silver, maybe 70 million ounces on a good day. The gap is massive, and that gap is the foundation of our $400 silver thesis. Let's talk about the specific dates that matter. These aren't random. These are the pressure points where the market will either bend or break. First notice day, February 27th, 2026. This is when the delivery month officially begins. This is when shorts must show they have metal or the ability to get metal. They can't just promise anymore. They have to prove it. If you're holding a short position and you can't demonstrate you have silver to deliver, your broker starts asking uncomfortable questions. Margin requirements go up, risk assessments change, the pressure begins. Last trading day, March 26th, 2026, this is the big one, the absolute deadline. Anyone still holding a short position after this date risks being assigned physical delivery. No more rolling, no more delaying. You either deliver the silver or you face default. Think about what this means psychologically. As we get closer to March 26th, every short position holder has to make a decision. Do I cover now while I still can? Do I try to source physical metal? Do I hope for a miracle? None of these options are good when silver is climbing toward $100 or higher. The window of comfortable choices closes day by day, hour by hour. Let's explore what happens if shorts try to roll their positions into May contracts. Rolling means closing your March position and opening a new one in a later month. Under normal market conditions, rolling is relatively painless. You pay a small premium and you're done. But these aren't normal conditions. We're in backwardation. Backwardation means near-term contracts are more expensive than future contracts. The opposite of the normal market structure. When you're in backwardation, rolling costs real money. Every time you roll, you're selling low and buying high. With silver in extreme backwardation, that cost could be $5 to $10 per ounce, or more. Now multiply that by hundreds of thousands of contracts. The cost becomes astronomical. But here's the bigger problem. May is also a major delivery month. Rolling into May doesn't solve your problem. It just delays it by 2 months. And in those 2 months, the pressure only builds. More longs stand for delivery. More physical demand emerges. Prices climb higher. There's another factor, margin requirements. As silver prices rise, exchanges increase margin requirements. They want to make sure traders can cover potential losses. If you're short silver at $70 and it hits $90, your margin call could be devastating. Many shorts won't survive the margin pressure. They'll be forced to liquidate. And when they liquidate, they have to buy back contracts. That buying pressure pushes prices even higher. It's a vicious cycle. Rolling into May only works if you have unlimited capital and nerves of steel. Most traders have neither. Option 2. Buy futures to cover. This seems like the obvious solution, right? If you're short, just buy back your contracts and close the position. Simple in theory, catastrophic in practice. Here's why. When you try to buy back a large short position in a rising market, you become part of the problem. Your buying pushes prices higher. This is called a short squeeze, and it's one of the most explosive moves in any market. Imagine silver at $70. A group of shorts decides to cover, they start buying aggressively. Their buying pushes silver to $75. Now other shorts are underwater. They panic and start buying too. Silver hits $80, then $85. The momentum feeds on itself. At some point, it's not about making a profit anymore. It's about survival. Shorts are buying at any price just to close their positions before losses become catastrophic. This is how silver could go from $70 to $100 in days, maybe hours. And here's the cruel reality. The shorts who wait the longest pay the highest price. The first ones to cover might get out at $70 or $75. The last ones could be buying at $150 or more. There's a game theory element here. Everyone knows covering is necessary, but nobody wants to be first. Until suddenly everyone tries to cover at once, and then it's too late. This is the nightmare scenario for shorts, actually delivering 900 million ounces of physical silver. Let's be clear about something. That much silver doesn't exist in deliverable form. COMEX has maybe 70 million ounces registered. That's less than 8% of what's needed. Even if you include eligible silver, the total COMEX inventory is around 300 million ounces. Eligible means it's in COMEX warehouses, but hasn't been designated for delivery. It belongs to someone else. You can't just take eligible silver and deliver it. You'd have to buy it first, at market prices, in a screaming bull market. Now think about trying to source 600 million additional ounces from the global market. Where does it come from? Mines? Mining companies have forward contracts and obligations. They can't just deliver everything to COMEX. Recycling, jewelry, coins, these sources can't scale fast enough to meet emergency demand. Government stockpiles? Most governments don't have significant silver reserves anymore. The reality is stark. The physical silver needed to cover 180,000 contracts doesn't exist. Not at $70? Not at $100. Maybe not at any price. This is why the $400 target isn't crazy. It's the price discovery that happens when shorts realize they literally cannot deliver. When the alternative to paying $400 is defaulting on your obligations. Suddenly $400 looks reasonable. Option 4. Do nothing and pray. Some shorts will choose the most dangerous strategy of all, waiting and hoping for a pullback. This is financial Russian roulette. Every day you wait, the market moves against you. Every dollar silver rises, you lose money. Your margin account bleeds. Your broker calls daily. The stress becomes unbearable. But you hold on because you believe silver must come back down. It has to. It always has before. Except this time is different. The structural issues aren't going away. Backwardation continues. Shanghai premiums widen. Indian demand surges. Industrial users scramble for supply. Each passing day makes your position worse, not better. And here's the psychological trap. After you've held on through $70, $80, $90, it becomes harder to exit. You've already lost so much. Surely it can't go higher. Surely this is the top. But it keeps going. $100, $120, $150. At some point, the losses become existential, not just for you, but for your entire firm. This is how trading careers end, how funds blow up, how family wealth disappears. Doing nothing isn't a neutral choice. It's a gamble that the laws of supply and demand will suddenly stop working. They won't. Let's game out a specific scenario. Silver hits $75 before March. At $75, margin pressure explodes. Shorts who were comfortable at $50 are now bleeding badly. Shanghai premiums are likely $5 to $10 over London spot. That means physical metal is even tighter in Asia. COMEX roll costs are brutal. Moving from March to May costs $8 to $12 per contract. Delivery risk is no longer theoretical. It's imminent. Real. Here's what starts happening. Weak shorts capitulate. They can't afford the margin. They can't stomach the losses. Their buying pushes silver to $80, then $85. Industrial users panic. Electronics companies, solar manufacturers, battery makers, they all need silver. They start bidding aggressively for physical metal. They can't shut down production lines. At the same time, retail investors notice silver is all over financial media. It's trending on social media. New money floods in, not just from experienced traders, from regular people who see silver doubling in months. The momentum becomes self-reinforcing. Higher prices attract more buyers. More buyers push prices higher. By the time we hit $90, the psychology has completely shifted. Nobody is asking if silver can go to $100 anymore. They're asking how high it can go. Analysts who predicted $50 scramble to revise their forecasts. 150, 200. Some whisper 300. And through it all, the shorts are trapped. Every option has become worse. We need to talk about China. Because what happens in Shanghai matters enormously to this story. The Shanghai Gold Exchange and Shanghai Futures Exchange trade massive amounts of silver. When physical premiums in Shanghai spike above London prices, it signals real shortage. Chinese manufacturers and investors are willing to pay more than global spot just to get metal. That premium gets arbitraged. Traders buy silver in London or New York and ship it to Shanghai. But there's a lag. Shipping takes weeks. Insurance, logistics, paperwork. During that lag, the premium can widen further, especially if demand surges or supply tightens. In a squeeze scenario, Shanghai premiums could hit $15 to $20 over COMEX. Think about what that means. If COMEX silver is at $90 but Shanghai is paying $110, where does the physical metal go? To Shanghai. Every ounce that can be shipped gets diverted to China. This drains available supply from Western markets. COMEX registered inventories drop even faster. The shorts aren't just competing with each other anymore. They're competing with Chinese industrial demand and investment demand. It's hard to overstate how this multiplies the pressure. You're not just fighting the market, you're fighting global physics of supply and demand. When every other option fails, futures exchanges have one last lever: cash settlement. Instead of delivering physical silver, they force shorts and longs to settle in cash based on a reference price. No bars, no trucks, no delivery, just money changes hands. This sounds like a solution, but it's actually an admission of total market failure. Cash settlement tells the world that the paper silver market is broken, that it can't fulfill its basic function. The credibility damage would be enormous. Not just for COMEX, but for all commodity futures markets. Who would trust these markets again? If they can just change the rules when things get difficult. More importantly, cash settlement doesn't fix the underlying shortage. Physical silver is still scarce, so spot prices keep rising. Industrial users still need metal. The crisis just moves outside the futures market. Cash settlement might save the shorts from immediate disaster, but it destroys the market's legitimacy, and it potentially sends physical silver prices even higher, because now there's no mechanism for price discovery. The market fractures. Physical metal trades at a massive premium to cash-settled paper contracts. You end up with a two-tier market: paper silver at one price, physical silver at another, much higher price. In this scenario, the $400 target isn't for COMEX contracts. It's for physical metal you can actually hold. Let's bring this all together. Why specifically $400? First, basic math. If shorts need to buy back 900 million ounces and only 70 million exist, the price has to rise until demand falls or supply appears. At $100, demand doesn't fall enough. Industrial users still need silver. Investors still want it. At $200, we start seeing some demand destruction. But strategic buyers keep bidding. At $300, the market is in pure panic mode. Price becomes secondary to availability. At $400, we've reached a level where almost all optional demand has been priced out. Only absolute necessity remains: critical industrial applications, strategic long-term holdings. This is the price where supply and demand finally equilibrate, not smoothly, but through force. Second, historical precedent. Silver hit $50 in 1980. Adjusted for inflation, that's about $160 today. But 1980 was just the Hunt brothers trying to corner the market. This situation is far more complex. We have industrial demand that didn't exist in 1980. Solar panels, electric vehicles, electronics. We have investment demand from institutions, not just individuals. We have supply deficits, mines closing, production declining, recycling insufficient. A $400 spike would be like 1980 on steroids, except this time, the fundamentals support it. Third, Comparative value. At $400 per ounce, silver would be approaching historical ratios with gold. If gold is at $2,500, a silver-gold ratio of 6 to 1 gives you roughly $400 silver. Historically, silver has traded between 15 to 1 and 40 to 1 with gold. 6 to 1 is rare but not unprecedented. In a monetary crisis or commodity squeeze, those extreme ratios can happen. How would we actually get from today's prices to $400? It wouldn't be a straight line. Markets never move smoothly, especially in extremes. Here's a plausible timeline. January 2026. Silver breaks through $60. Media coverage intensifies. Early February. Silver hits $70. First wave of shorts cover. Margin calls begin. Mid-February. February 27th approaches. First notice day creates panic. Silver spikes to $90. Late February to early March. The scramble for physical metal becomes desperate. Shanghai premiums explode. Silver reaches $120 to $150. Mid-March. As March 26th looms, remaining shorts face impossible choices. Price discovery breaks down. Silver gaps to 200 plus. Late March. Whether through cash settlement, defaults, or actual delivery somehow happening, the acute crisis resolves. But silver settles much higher than before, possibly stabilizing between $150 and $300. The $400 spike might only last hours or days. A true panic moment where bid-ask spreads blow out. But even if it spikes and falls back, the market has permanently changed. The paper-silver system has broken. Physical premiums remain elevated for months or years. A new equilibrium establishes at much higher prices. What this means for everyone. If this scenario plays out, the implications go far beyond silver traders. For industrial companies, this is a supply chain nightmare. Costs explode. Production delays cascade. Some companies might have to shut down temporarily. Others might switch to alternatives where possible. For investors holding silver, this could be generational wealth creation. Or it could be if you know when to sell. For monetary policy, a silver squeeze could indicate broader commodity market stress. Inflation concerns resurface. For financial markets overall, this kind of extreme move creates volatility everywhere. Correlations break down. Risk management fails. The COMEX situation becomes a case study in market structure. In what happens when paper markets lose touch with physical reality, regulators would likely intervene, new rules about position limits, delivery requirements, market surveillance. But those changes come after the crisis. They don't prevent it. The contrarian view. We should acknowledge the opposing argument. Maybe this doesn't happen. Maybe the exchange changes rules before it gets critical. Maybe shorts are more prepared than we think. Maybe industrial users have stockpiled enough silver to weather a spike. Maybe new supply appears. Maybe, just maybe, some longs decide to take profit rather than stand for delivery. If even 30% of longs cash settle instead of demanding physical, the pressure reduces dramatically. The $400 scenario requires almost everything going wrong for shorts simultaneously. That's possible, but it requires a specific sequence of events and decisions. Markets are unpredictable. Black swans cut both ways. However, the fundamental issue remains. There is not enough registered silver to cover 180,000 contracts. That's not speculation. That's arithmetic. How the market resolves that imbalance is uncertain, but that the imbalance exists is fact. Conclusion. So here we are. March 2026 approaches. 180,000 contracts stand for delivery. The shorts have four bad options: roll and bleed money, cover and spike prices, deliver impossible amounts, wait and pray. None of them lead anywhere good for shorts. All of them lead to significantly higher silver prices. Could silver really hit $400? Based on the mechanics we've discussed, yes. Not as a permanent price, but as a spike during peak chaos, during the moment when the market breaks. The key dates are February 27th and March 26th, first notice day and last trading day. Watch what happens around those dates. Watch COMEX registered inventories. Watch Shanghai premiums. Watch margin requirement changes. Watch how exchanges communicate about potential rule changes. These are your signals. These tell you how acute the situation is becoming. For most people watching this video, you're not trading silver futures. You might own some physical silver or mining stocks. If this scenario plays out, your holdings could multiply in value, but timing the exit becomes critical. $400 silver probably doesn't last. The spike resolves. The question is what level it settles back to. $100, $150, $200? That's the new normal after the crisis. The silver market is showing us something important. It's showing us what happens when financial engineering meets physical reality, when paper promises exceed actual supply, when leverage meets scarcity. This isn't just about silver. It's a lesson about how markets work at extremes. March 2026 could be the month we all get that lesson, whether we're ready for it or not. The setup is there. The math is clear. The pressure is building. What happens next will be fascinating, possibly historic, definitely worth watching. Thank you for watching. If you found this analysis valuable, let me know in the comments. Are you positioned for this potential scenario? What's your silver strategy? The next few months could change everything. Stay informed, stay prepared, and watch March closely.